Welcome back. Today, we're digging into a financial analysis report on YCBD stock, which argues that a recent 21% single-day drop is the ultimate dip buy opportunity.
A pretty bold claim.
It is. And the report does have a strong core. It nails the reasons for the crash, the dilution fears, the revenue stabilizing at 19.1 million.
And it lays out the bull case very concisely. That 0.7 times price-to-sales ratio really jumps out.
It does. I mean, the foundation is absolutely sound. But to really sell this, to make it truly convincing, we need to build on that deep value argument.
Right, and that's where we can start. So the analysis successfully establishes a deep value argument based on that PS ratio, but it critically lacks the required operational catalyst to translate this value into future share price growth.
I see what you're getting at. It's like you've shown us a cheap stock, but you haven't really given the market a reason to re-rate it.
Exactly. I mean, the weakness is that the report leans so heavily on the low valuation and, the analyst's $2.04 target. It kind of implies the stock will just bounce back on its own.
Mm-hmm. It notes revenue is stabilizing, but it doesn't give a concrete reason for any future expansion.
So the whole bull thesis right now just hinges on a technical recovery and sort of debt maintenance, not actual business growth.
Which is the classic value trap problem, right? Why should this stock ever trade at 1.5 or even 1 times sales if the company's just going to keep making $19 million a year forever?
It won't. I mean, best case, it bounces and then just goes sideways. The analysis needs to prove that the company's moving past just stabilization.
So what's the suggestion here?
Well, the suggestion is to really bolster that dip-buy thesis. You need to integrate specific, forward-looking operational catalysts, things that directly link the low valuation to future revenue growth.
You're building a bridge from stabilization to an actual increase in the valuation multiple.
Precisely. That makes the whole analysis proactive, not just reactive. It's not just a trade on an oversold stock anymore. It's an investment in an improving business.
Okay, so give me some concrete examples of that.
Sure. The report needs to detail what that $2.25 million they just raised is for. Is it going into new product lines? Are they going to aggressively expand marketing channels?
Or maybe improve their distribution network. Something tangible.
Right. The analysis should actually project how stabilization could credibly become, say, 5 to 10% growth next quarter. That's the kind of fundamental driver that justifies a 35% upside.
Yeah. If you can say that Cash is launching 2 new high-margin products by Q3, that completely changes the story.
It gives the market a new variable to price in. The PS expansion suddenly becomes logical, not just hopeful. It converts skepticism into actual conviction.
That's a huge point. Okay, moving on from the need for a catalyst, let's talk about the crash itself. The 2.25 million preferred stock offering.
The analysis rightly calls it the real killer. It was the trigger for the sell-off.
And it does a good job highlighting the upside, that the balance sheet is cleaner today because they paid off some older, more expensive debt.
But, and this is the next point, the analysis sort of dismisses the negative impact of that new stock too quickly. It glosses over the fundamental cost, which is why the market panicked in the first place.
Yeah. Investors don't dump a stock by 21% just because the balance sheet is getting tidier. They sell because they feel like their ownership is being threatened.
That's it, exactly. And you have to address that fear head on. So, to fully address that investor panic and strengthen the analysis, the report must more rigorously detail the financial mechanics and the long-term implications of this new preferred stock offering.
The common shareholder is sitting there thinking, okay, great, the company is safer, but how much of my pie did I just lose? You have to answer that question.
So the suggestion is to provide a more balanced and detailed view of this dilution event. You need to quantify the trade-off. Contrast the benefit, the debt cleanup, with the potential long-term costs of these new preferred shares.
You have to validate the fear before you can prove it was an overreaction.
Exactly. And for some concrete examples, you could start with a brief, high-level discussion on the structure of that preferred stock. Is it convertible? If it is, at what price? What's its claim on the company?
You could even do a quick calculation, like what's the maximum potential increase in the share count if all those shares were converted?
That's powerful. You anchor the risk. You take away the uncertainty that fuels panic selling. Or you could simply emphasize that the preferred stockholder has a superior claim to common shareholders. Explain why the market reacted so sharply. Once you've laid out the full picture, the bad with the good, then you can pivot and argue that paying off the old debt was worth this finite, manageable new burden.
That's a much stronger argument. You're shifting the narrative from, don't worry about it, to here's exactly how bad it could be, And here's why it was still the right move. That builds a ton of credibility.
It does. Now, let's transition to how this is all presented, the tone.
It's very high energy. I mean, the title alone, down 21% in one day, is YCBD the ultimate dip buy, with the alarm emoji. It definitely grabs your attention.
Oh, absolutely. And it matches the volatile nature of the stock. It's exciting.
But I think as you get into the analysis, that energy level gets maybe a little too high. It almost starts to work against the research itself.
And that's the critique. The high-energy, urgent tone used in presenting the bullish outlook risks undermining the perceived objectivity and analytical rigor of the fundamental research supporting the thesis.
Yeah, the weakness is pretty clear. You've got this very charged language, like calling it the easiest 35% gain of the year, or saying the stock is screaming for attention.
Right.
And for a sophisticated investor, that can feel like a red flag. It introduces a sense of bias and makes the core value claims, that solid 0.7 times PS, sound a little less like research and a bit more like hype.
I mean, experienced investors are just naturally skeptical of hyperbole. When they see a phrase like easiest gain, they immediately start looking for what they're missing, because nothing in the market is easy.
So the suggestion isn't to kill the enthusiasm, it's to adjust the language, right?
Exactly. Adjust the language to maintain that high-risk, high-reward assessment, but frame the findings using more calculated, objective financial terms. It reinforces credibility. Basically, let the numbers do the shouting.
I like that. So how would that look in practice? Let's take the technical section, the play.
Okay, for a concrete example, look at rephrasing the technical analysis. Instead of stating the gap fill back up to 180, 190 is the first target, which sounds like a certainty,
Right.
you could say something like holding the $1.50 support zone suggests a high probability reversal targeting the previous resistance levels near $1.80, well, $90.
That's a small change, but a huge difference. You're acknowledging that risk exists, that the whole thesis depends on that support level holding. That's what a seasoned investor looks for.
It's about probabilities, not certainties. And similarly, you can replace those overtly bullish phrases. Instead of screaming for attention, maybe note that the current extreme volatility creates an asymmetric risk-reward profile.
Asymmetric risk-reward profile. That language is professional, but it's still undeniably exciting. You're translating the hype into a language that serious investors trust.
And when you do that, the whole piece becomes stronger. It appeals to both the value investor and the technical trader, and you get past that initial red flag of a promotional style.
This has been a really insightful breakdown. I mean, fundamentally, this is a very strong analysis report. The core thesis that YCBD is oversold because of an event that actually improved its long-term health is powerful.
It is,